of the Hanover Rotary Club, who will introduce our speaker. Christine?
I guess from that comment, I drew the short straw between Jim May and Steve Feldman, but what can I say? You know, I'm sort of used to this. That's the treatment I get. But actually, I'm very, very happy to be here, and I will say, having been a 25-year member of the Hanover Club, we have approximately 100 members, and we have had that throughout my entire tenure there. So I know this is a very large club, but we're very proud of our club too. So anyway, I'm Chris Neary. I'm the regional manager for Wilmington Trust for Southeast Pennsylvania, and it's my pleasure to introduce my colleague and your speaker today, Sam Fraundorf. Sam is the Senior Vice President of Wilmington Trust and is the Chief Investment Strategist for us. In that role, Sam is responsible for investment research, platform design, and innovative investment solutions. In addition to holding a certified financial analyst and a certified public accountant designation, Sam holds dual bachelor's degrees in accounting and finance from the University of Idaho and an MS in finance from Georgia State University. Today, Sam will discuss with you Wilmington Trust's current 7-year capital markets forecast. Thank you.
You know, I get to speak very frequently, and I enjoy doing it, but I have to say I'm a little bit unnerved to come and speak to all of you. I've had so many people come and explain to me the relative importance of this club, what you all have done, and I'm speaking in an auditorium that, quite frankly, is about as nice as I think I've ever seen. I'm a big fan of historic architecture and so forth, and this is, for me, really terrific. My talk is about 2 hours in length, and I was told I can't be anywhere near that. But I live in the South, and so I can actually talk relatively fast. And the more bourbon I have, the faster I can actually talk. So I'm going to give you our capital market forecast. And you'll be able to see it at the other end there. To the extent that you'd like to look at that. There's a number of slides in this deck. I am not going to hit them all. If you would like to comment, Steve Feldman has been more than gracious to offer those to you. We've got them in electronic format, and I'm happy to share all that with you. There's a lot of great information. This takes about a dozen of us, about 2.5 months each year to go ahead and put together. There's a tremendous amount of information that's in here, but I can't get you all of that in an amount of a lot of time, right? So the first thing I'm going to do is let's cut to the chase. What you really want to know is what in the world am I predicting? And these are the 3 items I'd like you to walk away from here. First of all, that the U.S. is still the dominant global economy, and because of that, it will tend to have a better economic base, and it will tend to generate slightly better financial opportunities for investors over the next 7 years. I use a 7-year horizon because you won't let me forecast over 20 and 30 years. I am the best 30-year forecaster you've ever had. And there's a little bit of a joke in that, right? Because actually I'm better at 29 years than I am at 30. But the real answer is that over 30 years, the real drivers with regard to economies, financial pricing, and so forth come to light. As I start to shorten that horizon, the problem is there's an awful lot of noise that can swamp the story that's happening underneath. 7 years is the shortest I'm willing to go ahead and go and be able to provide this amount of information. The reality is you probably like to move down to a year, and if at all possible, if you tell me where stocks going to be next week, this is long enough for you to go ahead and get in the market and the answers. I wish that I could, but then if I was, we would all be doing this someplace very warm with sand and then drifting up on the ground within the night. Low returns for bonds are going to continue on for the next several number of years. However, because they are lower volatility than alternative deals we have, you're going to want to have them in your portfolio. I'm going to specifically ask why that's going to be the case. Keep in mind, bonds are your hedge against bad things in the world happening. And as much as I would love to tell you that nothing bad is going to happen, I can't. I don't know how long Israel is going to be patient and not say, you know what, I'm going to take this whole Iran thing into our own hands. I've got a couple of jets, let's just take care of this nuclear thing, we'll take it off the table, right? If they were to go ahead and do that, or a host of other things like you very easily imagine, you're going to watch the markets react very violently, and your safe asset will be bonds, most likely U.S. sovereign bonds. Don't get rid of them in your portfolio. last thing is emerging market stocks will tend to do probably better than everything else, and we'll probably include the U.S., and there's reasons for that. More specifically, we've had a relatively tough time. There's a better financial position with large manufacturing growth that we're going to see in those developed countries, even in terms of growth that we're going to see in the U.S. I was wondering if I need to pick this up a little bit. I've been told that there's only one person on the face of the planet who talks faster than me. I haven't found her yet. But I suspect I might have married her. How's that? I can talk about it. Now, that's the cut to the chase. That's the answer at the end. Let me tell you how I got there. If you can't hear me, raise your hand. If you can't hear me, ask for raising your hand, then don't raise your hand at all. All right. Because once you understand how we got here, you'll understand exactly why this is what I'm predicting. You might even have a little confidence that I'm halfway right. Economies run in cycles, and we're all very familiar with that. The problem is you probably think about what is more the short run cycle, right? Which is boom to recession, back to boom again. And those do tend to roll, and usually they average somewhere in the neighborhood of 4 to about 7 years, all right? And we see those very frequently, and that's why we're most moving. There's actually a longer run cycle that runs underneath that. And those long run cycles can run for decades, they can even run for centuries. And two of the characteristics that we see, regardless of whether on a long run or a shorter run cycle, is that credit tends to increase and decrease during those cycle runs. It's a very natural aspect. As economies grow, there's more consumption, there's an opportunity for more borrowing to go ahead and fit in behind that, and you watch balance sheets both at household levels, at business levels, and at governmental levels start to increase to some extent in order to go with that consumption and that economic growth. It starts to turn itself over, there's a contraction in credit that comes back the other direction, and the cycle repeats itself back again. And this is very, very normal, and economies tend to do this. Economists would love to smooth all that out, but they've never been absolutely perfect at it. Long-run cycles, though, are a little bit harder to some extent to see, and we've been on one in the U.S. ever since, quite frankly, before the Second World War. The U.S. in the Second World War expended a tremendous amount of debt at the government level in order to finance the war effort, and that process continued on in household expansions through the 1950s, 60s, 70s, 80s, and into the 90s. All right? And all of that led to great technological advances, increases in middle class, all the wonderful things that we ended up seeing. What happened in 2008 was a coincidence of both those cycles starting to turn over. We started with a short contraction, and we started with some contraction in the longer run cycle. They coincide. Usually they don't. They can. They did. We can point fingers at what it was. It was those darn low mortgage, I don't really care. They both coincide, all right? When that happens, economies start to have troubles. And the first thing that starts to happen is borrowers no longer have as much capacity to service their debts. Now, that seems to make perfect sense. Here's the problem. As debt can't be serviced, it starts to walk away. You start having the writing off of that. And that causes tremendous damage to the economy overall, and particularly to the lenders. So if you are a central bank, if you are a government, what you want at all costs is to try to keep those loans viable for as long as you possibly can. I'm not saying that they have to continue to exist, but you want a very orderly process of those loans starting to unwind. Write-offs and all the rest. You don't want it to happen rapidly, and you don't want to have it happen in a disorderly fashion. That is a very bad thing with regard to economies. And you end up with bank runs, you end up with market crashes, and you end up with tremendous damage to economies that take long periods of time in order to go ahead and fix themselves out. And you only have to go back to 1929 to poster child of that kind of disorderly unwinding associated with that debt issue. So, if you're a central bank and you want to keep those loans viable, what's the first thing you end up doing? And the answer is lower the interest rate. Lower the cost of servicing the debt. So the first thing you do is you lower the interest rate in order to make that easier. Once you do that, and it's still not enough, the next thing you have to think about is what happens into the overall economy. Because as those loans start to get written off, you are extracting liquidity from markets. All right? My wife comes home. There's this red light on the car. It looks like a little can with something dripping out of it that's red. That probably doesn't mean anything, does it? I mean, I can ignore that for a while, right? And I'm screaming, oh my gosh, no, that's the oil. You you've got, oh no, don't do that, don't ever run the car with that light on because the engine will seize. Same thing is true in financial markets. If you don't have enough liquidity, financial markets seize. Liquidity is the oil that keeps them running. And as debts start to shrink and come off, you've got to do something with it. So if the interest rate wasn't enough to keep those debts in line, then you've got to replace the oil. You've got to replace the liquidity. And so central banks started doing quantitative easing. They started printing money and pushing it into the economy in order to let it do this. All right? Now, everybody knows that. You've all seen it. What were they trying to accomplish? Keep in mind, we want the debts as best as possible to go ahead and service. To service a debt, I need to have top-line revenue. I need to have income in order to make the debt payments. So the income statement for an economy, take the U.S. economy, we generally look at that's GDP, gross domestic product. That's our income. That's all the income that we're rendering from goods and services, sales, transactions, everything goes on in the economy. And we usually look at it just in terms of period-over-period growth, right? That's GDP growth. We usually show that in real terms, so net of the inflation component of that, because economies will grow just by virtue of the inflation. And we're looking at that growth. I need that to be positive. I need it to be top-line growth so that I can grow into the debt service that I'm trying to have. So central banks need positive GDP growth. I need GDP growth ahead of the rate of inflation. Right? Because inflation pulls away my purchasing power. I can't then use the money to service the debt. I have to use the money to go ahead and pay for whatever, right? I got housing, I've got food, I've got whatever else it is I need. So I need inflation to be below the GDP growth rate. And the last thing I need is I need the return on cash to be lower than the rate of inflation. I need people to lose purchasing power if they decide to hold cash. Right? If I'm getting 0 on cash and a 2% inflation rate, holding cash means I lose purchasing power. I want to turn around and spend that money. We're sitting at a meeting 6-8 months ago, CEO roundtable, about 15 or so CEOs up in New York City. And one of them told me that inflation was an evil thing and we should not have inflation. He was going to argue this with me. And I'm not really an economist. I mean, I might play one on TV, but I tried to tell him, stop. The reason that we want some level of inflation, and keep in mind, the Fed Reserve has this as a mandate. When Congress formed the Fed Reserve, they said, please make sure there's some inflation in the economy. Right? Congress asked for it, and the reason is that if you think goods and services are going to be more expensive next week than they are now, you're going to tend to want to buy right now. And if you buy now, then whoever you bought it from now has income and knows, hey, I have some more, I'm going to go buy something. And there's this wonderful reoccurring cycle that kind of reinforces itself, right? Conversely, if you think things are going to be cheaper next week, disinflation, deflation, are you going to buy now or are you going to wait till next week? You're going to wait till next week. And then next you're going to look and say, maybe I can wait another week longer. And so you delay consumption. And what ends up happening in that case is now you don't have an emphasis and economies start to shrink. Shrinking economies. Remember I said I get a positive GDP growth, not shrinking GDP. I need positive growth so I can service the debt. So what ends up happening? You need positive GDP ahead of inflation, inflation ahead of cash. What have we had here in the U.S. for the last number of years? We've had GDP right around 2.5%, 3%, right? What's the inflation rate? Slightly less than 2. What's the rate on cash? 0. We've got things in the right order. Because of that, we have gone through this crisis, this contraction, this deleveraging better than almost everybody else on the face of the planet. You know what the most evil thing in the world is? I'm going to change subject for a second, but hang on. The most evil thing in the world is Amazon Prime. And the reason it's so evil is that anything your heart desires can show up in 24 hours on your front door. So, my wife loves to run. Big time marathon runner. I try to keep up with her. I got to stay at least halfway good looking, otherwise she's going to drop me like a hot potato and find somebody else. Hurt my knee. So, right around the start of the year, she said, I've got a great idea, honey. I just ordered off Amazon Prime. I'm an evil. This new thing called P90X3. If you're not familiar with it, this is basically legalized torture. With the tagline that you can do anything for 30 minutes. I'm here to tell you, there are parts of my body that will absolutely argue with you can do anything for 30 minutes. But we're in this thing, right? And I am sore. I'm having a tough time, right? You know, some of these moves. And she's like, you know what? If you had just started this earlier, it wouldn't be so bad right now. If you had just started this earlier, it wouldn't be so bad right now. All right, nothing to detour. The U.S. has done all of this. What is the rest of the world now starting to try to do? European Central Bank announced a 1+ trillion euro expansion. All right? Thank you. Somebody always catches that. The rest of the meeting I said, I wait for it. I'll buy whoever that was a drink or a piece of cake. And I'm running out of time, so let me go a little bit faster. There are seatbelts underneath. You all just want to reach underneath. We're going to go ahead and finish this off. All right, we've got the central bank in Japan doing exactly the same thing. All right, we've got a meeting this week of the G20 economies, the largest 20 largest economies in the U.S. More than half of them are in some form of easing right now, whether that's interest rate or quantitative easing. All right, everybody else is trying to do what the U.S. has already done, and you know what? It probably makes some sense, and it's not going to work as well. They are late to the game because there's already a substantial amount of liquidity that has flowed into economies. They are behind the times. Mrs. Fraundorf said, if you'd only started it earlier, it wouldn't be so bad right now. We took the medicine first, and it's the reason why the U.S. will remain the dominant. I'm going to finish this off. Why will we remain the dominant economy? That's the reason why we got there. Low interest rates, but they're going to stay in. Interest rates can't rise yet because there isn't enough global growth in order to support it. As global growth increases, rates will rise, but that secret that everybody's been whispering to you that rates are going to rise and you're going to lose money in your bonds, yeah, they may come up some, but you're still going to be able to eke out a positive return in your bonds because rates can't get too high because we still have to have our hierarchy working its way through until the deleveraging is done. How will we know it's done? When we start watching businesses and households increase rather than decrease the amount of debt they have on their balance sheets. We are still in somewhat of a contractionary response, and that's something that banks are looking at, that's something the Fed is looking at, that's something we all as investors have to be looking at. Lastly, emerging markets will do well because they haven't had the same kind of debt increase that the rest of the developed world did. They didn't jump on that long-term cycle in the same respect as everybody else did because it has been hard for emerging markets to pick up debt. Every time they try to do it, it ends in the same fashion, which is a fiery, destructive mess, and investors don't want to go back. Where's Russia right now? Pleading for cash. They've got to have borrowed, and they're not going to go ahead and get it. The rest of the developed world doesn't want to go ahead and do that. They are the exception, the outlier with regard to aspects of this. So the reason why we are here is because this is how the world has reacted to what is a normal cycle event, and how each country made its decisions on how to react, and when they made the decisions, only started it earlier. It wouldn't hurt so much right now. That's how you end up getting it. In the rest of this deck, I'll end up showing you aspects of interest rates. I'll end up showing you exactly how returns end up coming with regard to bonds and stocks. But if you're thinking as an investor, have a preference for U.S., don't walk away from bonds, don't be afraid of emerging markets, and please don't walk, though, completely away from Europe and everything else. They are screamingly on sale today because nobody wants to make that investment. You should be nervous as an investor when everybody tells you invest in the U.S. and nothing else. Because when we all agree that's what it's supposed to be, you know it can't possibly be right. Now, I would love to answer any questions. It is entirely up to you. I call this portion of the meeting Stump the Chump. I will play the chump. Thank you. Get out of town. I rolled through this and I've got 90 minutes. So I'm lucky enough to find myself in New York. What can I do to help any of you out? What question can I answer for you all? And if you don't, then I'm going to look at these other two charts. That's it. Right. Yes, please. So I'm going to kind of go. He says he likes what I've said, and I'm very smart. He thinks I can possibly be even smarter if I answer this question right. So the question is, given what I've stated in terms of the level of inflation and growth rates as we currently see them in the U.S., how confident am I that the Fed is going to be able to start raising interest rates come the middle of this year, which is the signal that the Fed's been trying to give all of the world? Or are they going to have to delay with regard to making that increase? So let me see if I can get this one right, because then I'm really smart. And by the way, if any of you want my wife's email address to tell her I did a great job, come see me afterwards. I will appreciate that, because Valentine's Day is 3 days away. The Fed desperately wants dry sand under its feet. At 0 to 25 on the short-term rate, there is no dry powder under the Fed's feet. And that means that if there's anything that ends up happening, the only thing they've really got left to go ahead and play with is prove any kind of effective has been quantitative easing. And they've already done that to the tune of more than $4 trillion on the Fed balance sheet. So the Fed really desperately doesn't want to do anything more with it. Now, a $4 trillion balance sheet, though, actually does have some ability to influence the economy. So what the Fed does with the interest from those notes, what it does with refinancing those notes as they come due, also has some play in this. And the Fed has got a separate committee that they formed over the last number of months to look specifically at that. But they desperately want to have dry powder, which is raising rates underneath their feet. What is the right answer, quite honestly, for interest rates? And here's the curve. I'm going to focus for now on the 10-year, which is the portion right there. If you can't read the text, okay, I'll tell you what the numbers end up saying. As this is showing right here, we did this back on June 30. It said that the 10-year was 233. It's at 2 or so, $1.99, actually, when I looked at the market earlier today on the 10-year. The natural rate for the 10-year bond ought to be the rate of inflation plus GDP growth. Rate of inflation plus GDP growth. That's a good thumb sketch if you want to think about that. Right now, inflation is running what, about $1.80? GDP growth is coming around 2.6. Add those up, they get you to what, 4.4? And if you take a look at what I've got up there, I'm at 360 or so, right? I'm actually less than that, because I don't think we're going to get all the way there in the 7-year horizon, because they can't increase it that much. So, to answer the question, are they going to do it in June? They're going to be very data dependent. The labor report that we just got on Friday gives them more than enough powder, I think, if it continues in that kind of fashion, to be able to go ahead and do it, and they probably will. I don't think that we've got enough labor strength yet in order to push inflation higher, but there's very much a difference between what Ben Bernanke wanted to go ahead and do in the order of it and what Janet Yellen does. Okay? They're both absolutely outstanding central bankers, and I have the utmost respect for both of them, but they do think of the world a little bit differently. Mr. Bernanke said, I want to see that inflation, because if I have that inflation, it's going to force people to consume, and if they consume, it's going to force production. Production means we're going to have to put people to work in order to do that, and working people is a good thing, and we complete the cycle back on the other side, all right? Mrs. Yellen says, I want people to work first. I want employment first, because if they're working, then they've got money, then they will consume. Consumption will lead to inflation, we'll end up going in a circle in that direction, right? It's the same circle. The question is, where do you end up starting? Because this Fed chairman starts with employment, I'm paying an awful lot of attention to what happens on each of the Fridays over the next number of months. And as long as we continue to see employment growth like we've been seeing, big numbers that we came out on Friday we didn't pay attention to was participation rate was up, hourly wages was up, and these were big numbers versus what we've seen. In fact, some of the best numbers we've seen in the last 7 to 10 years for several of the numbers we're in the report. She loves that. Fed loves that. It gives them lots of opportunity. If you see that, then yes, you will see rate rises in September. June. Market's been delaying. Market right now is brought in. They were actually much later November. Futures came back now into about September with that most recent report, which is getting closer to where the Fed says they want to be. We've watched the 10-year move from about $1.63 to start February to about 2% right now. That's about 35 basis points or so worth of rate increase, and we've already seen in the 10-year. That is a market finally saying, okay, Fed, we get it. We know what you're doing. Market keeps moving in that direction. Won't be as big a surprise for the Fed. Employment keeps coming in. So yeah, right now everything is lining up. The Fed's going to be able to do what they want to do, which is mid-year. Yes?
How would you sum up the pluses and minuses of the current low oil prices on the U.S. economy, and where is the sweet spot?
All right. Now I'm not going to be smart. Because I'll be very honest with you, I am not going to be able to predict the price of oil. But you didn't ask me to predict, and I thank you for that. You asked me, where is the sweet spot, and what are the implications right now in terms of oil price? So let's look at this from a U.S. standpoint, which is a big darn deal. What we have happened is we've had a tremendous expansion in U.S. oil production capacity through fracking, right? It's huge. In fact, it is so huge that it's been able to take up all of the increased needs of the U.S. and then some over the last number of years. That means that we have not been having to increase our purchasing from OPEC for the last number of years. We've been able to do it with our own production. And last year represented the first time that we've actually exported oil since, I believe it was Nixon that ended up writing the law saying that we weren't allowed to do that anymore. So it's a deal, and it's a huge deal. And OPEC doesn't like that. OPEC wants to have more production from their standpoint, right? Production times the price of barrel ends up being revenue for them. They are willing to go ahead and take less money, maintain production at the same level. That does a couple of things for them. It puts a tremendous amount of pressure on Russia. It makes geopolitical statements throughout ISIS and wherever else in the Middle East. Saudi Arabia loves being able to go ahead and do that and take financing away from those types of regimes and those kinds of political issues. It also has cost problem of reducing the efficacy of the fracking wells here in the U.S. Fracking is a fairly expensive process, right? We've taken as much of the cheap oil we can possibly find in the U.S. And so fracking becomes very unviable at the numbers that we're seeing, $43, $44 a barrel. Right now we're sitting around $51, $52 a barrel. When I looked at it close on Friday, I didn't look at it yet today, but I think we're still kind of in that particular range. Markets, by the way, like that. Part of the stabilization we've seen in terms of equity markets over the last few days. In fact, it looks like we've at least hit some form of a bottom or resistance point with regard to oil prices. You're going to continue to watch some aspect of fracking come offline because it's just not viable at these numbers. That reduces some aspect of the production, and that's what this whole thing has been. This has been a supply-oriented route. This has not been demand problem. So anybody that thinks that, well, the economy's slowing, that's what the problem is, it is not an economic slowing issue. This has been way too much supply, and it's being fixed in terms of this pricing structure. So where is it going to end up? Saudi Arabia can't withstand this for probably more than 2 years, and they may not have the political wherewithal to do it for more than a year because of the tremendous cost. We're talking about hundreds of billions of dollars worth of lost revenue in Saudi Arabia for going ahead and doing this. So you'll end up watching this happen for a short period of time. This is interesting for them to go about doing this because normally they would have just let this play out. Fracking is probably a 7 to 10 year kind of event in the U.S. before it doesn't have the same kind of input. And the reason is that frack well runs out really quickly. It's got a very fast decay associated with it. So you generally end up getting oil for somewhere in the neighborhood of 3 to 5 years out of a frack well, and then it just starts to dribble off. And so you have to continuously find new frack wells in order to be able to do this. And so you would have something in this neighborhood, say 5, 7, 8 years, that Saudi Arabia could just dealt with the loss of production, and then it would have burned itself out. They decided not to go ahead and wait, and so they've lowered it. To answer your question, therefore, I think we're going to stabilize at something well lower than, say, the $100 rate that we've been seeing for quite a while. I think you're probably going to be somewhere in the $60 to $90 range, maybe $60 to $80 range over a longer time period is where it'll probably end up stabilizing, because at that level you get some fracking online, but not a lot of it, and that probably ends up being a spot where Saudi Arabia and the rest of OPEC is willing to go ahead and live with it. But you're going to have to burn off the current oversupply that we have. I think we're a good number of months, if not more than a year away, before we start seeing some stabilization in oil prices rising higher than that. What does it end up doing to the U.S. economy? And I know I'm speaking very slowly. Can you pick this up? You end up with a wonderful benefit to the households, right? We talked about this as the oil rebate. And so households have a lot more to go ahead and spend. And what they've done is they've used this in two fashions. One is they've used it on their balance sheet. The savings rate has increased in the near term, all right? And that doesn't mean people are actually saving. It just means they're not spending it. We take a look at income versus outflows at the household level, and if it doesn't net out, we call it a savings rate, right? And so the savings rate's increased. That means that people have been using this to pay down additional portions of debt more likely than not. This is still part of that deleveraging cycle that we've ever seen. Some households probably are saving it, but they haven't spent all of it, all right? So the problem is that this immediate decline, right, in prices, which is taking revenue off the books, dollar for dollar on the oil energy sector, has gone into the household, but it's not being respent dollar for dollar because a portion of it is getting lost into the balance sheet. So you don't have one for one with regard to that benefit. Households are turning around taking and spending that. When they spend that, right, that ends up being consumption. That's a really good thing, all right? But the consumption doesn't equal what came off the books from a consumption standpoint, right, on the other side of oil prices from the energy sector. The other is they end up diffusing that across a wide number of purchases, right? There's a decent amount of slack in the economy. So those purchases go out, but it probably doesn't relate to CapEx, all right? It doesn't relate to expansion from a fundamental standpoint. Reduction in oil price though does reduce the capex spend in oil, right? Big energy is not doing the kind of exploration. They're not running the wells. They're not doing the capex that they've been doing previously because the price is too high. So net overall, you end up with a drag, believe it or not, on the overall economy because you're transferring stuff from a fully deployed sector to sectors that have greater capacity that haven't had to use that yet, and so you're going to lose some of that in terms of friction. So net, this will actually long-term probably have a little bit of a drag on GDP, but I think the numbers going to probably, the numbers I've seen are anywhere from about 20 basis points to maybe 50 basis points worth of drag. So instead of saying 3%, you might see a 280 or 250 GDP growth rate number over the longer horizon as long as this ends up lasting. Like I said, I think you're probably about a year or so out before that starts to stabilize itself, so we'll probably have a little bit of a drag in GDP because of how that plays itself. Does that make sense? Yes. I know, I got, you're next. Sorry, I should have. Heroic assumption.
That's an important assumption. Our current economic position in the world, do you think that better positions us to get favorable trade agreements in Europe and Asia, or again, taking the politics out of it, where do you think we are positioned in terms of trying to get favorable trade agreements?
So the question is, where does the U.S. stand given its economic strength today vis-a-vis trading partners in Europe and Japan and elsewhere? And look at that X, what it might mean from a political standpoint. So the answer is we're in a position of strength. Greater growth, more production, more consumption. You're seeing, if we take a look at how earnings reports for this for Q4, right? Fourth quarter 2014, all those earnings reports have been coming out over the last 4, 5, 6 weeks. And one thing you have to take a look at all of the global businesses is they're all being hit with regard to their ex-US incomes. Right, the currency impact in terms of the U.S., stronger dollar, weaker way, means if you end up losing money, you start bringing those profits back into dollars to go ahead and report. And secondly, it's expensive for them to sell ex-U.S. because of what the dollar is. So they're watching foreign sales start to reduce, all right? That's because everybody wants what we end up having. Conversely, you're watching imports into the U.S. skyrocket. U.S. consumers want to buy all that stuff because it's cheaper. We have import-export numbers that are actually going to come out on Thursday this week. I'm going to be watching them very carefully because I think it's going to reinforce what I've seen in the earnings season so far from multinationals, is that money's going to continue to flow into the U.S. That means that we are in a position of strength in terms of dictating what those trade agreements ought to look like. Your point is, will we end up doing anything with those? Because if you piss off a neighbor today who's weak, they're going to come back and kick you in the shins at some point when they're strong. So I don't suspect that Congress probably has the political wherewithal to try to make anything out of the relative strength that we have currently. I think you'll end up seeing most of this play itself through the earnings statements and the struggles of multinationals versus domestic-only companies for the time being.
Businesses talk about that equity ratio. What about individual households? Is there an optimal number? You don't want households to be leverage.
So the question is there an optimal level for a household in terms of income to debt? Because businesses tend to have aspects of that. And yeah, businesses, it differs, right? Different industries can support different levels of debt, and an aspect of that depends on how stable the industry itself is, and then also what government regulation might even allow with regard to that. Because in certain cases, like the banking industry, right, we don't get a lot of choice in that. The government's going to tell us what we're going to end up holding on our balance sheet. With regard to the individual standpoint, you're exactly right. Trying to support a debt-to-income level of 100% or more becomes unsustainable over long horizons. And the reason is that there was always going to be friction in terms of employment, recessionary aspects, and so forth, that 1-to-1 ratio becomes unsupportable. We were very close to that going into the 2008 crisis. Since that point in time, we watched the average debt in households drop down to around 82% of income. That's probably a very sustainable number for most incomes and for most households. Excuse me. Is there an optimal level? That there really isn't, because there's a wide variety of sourcing and so forth. So the amount is dependent on how stable the income level itself is from an earnings standpoint, and how stable the employment situation is in the industries and the geographies where individuals end up finding themselves. But certainly something in that 80 to 85% range is something that over long horizons the economies have shown households having very little problems supporting that. And when I say little problem, I'm thinking from the standpoint that the problem doesn't exacerbate itself into macroeconomic problems for the overall economy. It can reside at household levels, and individual households will work themselves out. And it doesn't, we use the economic term idiosyncratic. It stays idiosyncratic within the household rather than systemic, that it ends up affecting the overall economy. At levels that are closer to 100, now you've got systemic issues. The overall economy is going to be at risk because of that average level of debt. Does that help? You all have been absolutely outstanding. I've only seen 3 of you go to sleep because you didn't have enough dessert. If there's anything that I can do or that any of us can do in terms of questions you have today or going forward, please give us a call. We would absolutely love it. If you can tell, I enjoy doing this to no end. I hope it's been helpful for you all. I hope you walk out of here a little bit smarter and more important that you think that I'm really smart and I've been successful.